Investing in biotech and life sciences can offer phenomenal returns, according to Andy. In this episode, we dive into the why the UK companies are so structurally undervalued, why this might be a good opportunity for investors, and this new fund, and the current state of the industry, whether it's to cure cancer, build surgical robots, or livestock farming. As always, I'm your host, Michael from Foxy Monkey, a website about company investing, tax, and financial independence. If you're a business owner, please check out the Company Investing Academy. It covers a wide range of topics for investing your business cash. More than 200 people have taken the course and joined our community. Check it out at companyinvestingacademy.co.uk. Please note that nothing in this episode should be considered as financial advice. As always, do your own research. And now, on to the episode. Hi, Andy. How are you today? Welcome.
Thanks, Michael. It's very nice to see you again.
Nice to see you again. For those that don't know, Andy's a repeating guest, Andrew Craig. I had a pleasure to talk to Andy, I think last year it was, and we had a great time talking all things investing and building wealth. Short introduction, Andrew Craig is the author of the bestseller How to Own the World book, and he's also the founder of the Plain English Finance Company, a place where investors can understand more about finance investing and build wealth for the long run. Now, Andy has also another focus in life sciences and biotech, and I really wanted to discuss about this new area. Although I don't think it's new for you, Andy, because you had I think your background is in that area. So tell us a little bit about that.
It's been the last. So I've been doing basically focus on smaller company equities, which is anything less than the goalpost movement, maybe £2 or £3 billion size, all the way down to very, very small companies. Has always been my focus since the late 90s. And in the last 8 years or so, basically since the end of 2014, I've specifically focused on life sciences companies. And we can perhaps define, because life sciences covers a lot more than just biotech, but we can perhaps come on to that.
Exactly. And for someone that is, new into this area, I think a lot of people learn more about the area thanks to COVID, right? I mean, It wasn't great that we had a huge pandemic and, everyone started talking about that. And suddenly there is there is interest, a lot more interest, let's say, in this area. But tell us a little bit about life science and what it means and basically how it differs and, what are the different areas that people are interested in these days.
Yes. So the way we define life sciences, basically, people often, if you say life sciences, people immediately think of biotech and people in labs with millions of pipettes doing lots of experiments and the key focus of business like that is front and center trying to cure cancer or autism or come up with a really effective treatment for obesity or any number of diabetes, obviously. So any number of things that kind of big pharmaceutical companies do. And in the last 20 years or so, the biotech bit of that technology has really, really advanced. And the sort of whole approach you take to, if you like, from chemistry and synthesizing chemicals, which was the foundation of the pharmaceutical industry, going all the way back to like the 1880s. And when we came up with the first few compounds, particularly big German companies like Bayer, and Merck, they developed that sort of chemistry. And then over sort of through the sort of after Watson and Crick in the 60s, the discovery of DNA, and there's this very, very rapid acceleration of the technology, biotech and the delivery of treatments, pharmaceutical treatments that come from biology and biotech really started probably in the late 80s, realistically. I mean, you can argue maybe it was the early 80s, but it depends. And then in the last 20 or 30 years, it's really come on. So that's the therapeutic bit where you're, if you like, trying to cure cancer or trying to develop new drugs. Very, very expensive and complicated. But then a key part of our thesis is that many of them are becoming less expensive because of the march of technology. But we also, within life sciences, we also talk about medtech and medical devices. So it's really any kind of area where you're using biology and biological technologies to deliver a kind of economic outcome for human beings. And actually, just to unpack, so as I say, that'll be one of the companies we're very interested in has a simple blood test that can be used for advanced cancer diagnosis, which is, if you like, the holy grail of cancer diagnosis, because instead of a really painful, invasive, surgery under general anesthetic where you want to go in and biopsy a late stage lung cancer patient or a breast cancer patient, you've actually just got a simple blood draw that gives you the same, just as good information about what you should or shouldn't do with that patient. And these are all the sort of, if you like, at the coal face of what these businesses can do. And, a lot of people are very cynical about big pharma, the anti-vax community, and big pharma hasn't always covered itself in glory. But at the same time, in my experience, having worked with this area for the last 8 years, there are far more mission-driven people trying to improve patient outcomes and strip cost out of healthcare, actually, than there are kind of evil, rapacious capitalists trying to, force governments to do nefarious things. And I think that's great. So I'm writing a book at the moment called Our Future is Biotech, and it's one of the points I make in there, hopefully that's reasonably well evidenced. I mean, they're as with many, there are bad actors in any industry, but I think that the pharmaceutical industry gets a disproportionately bad rap because of the kind of the long memory of some of that. But the final thing to say is, which is also really important, is so it's therapeutic biotech, it's curing cancer, it's better diagnostics, it's surgical robotics, it's all sorts of stuff around the healthcare sector. But life science as a whole is about way more than just healthcare. Mm-hmm. So, for example, if you like, whenever we talk about this stuff with investors, particularly, and indeed anyone, my view is that in the last century, really, of kind of human progress has been mainly about physics and tech. And so, going back to certainly the early part of more than a century ago, it's been waves of locomotive, aviation, automotive, transistors, silicon, smartphones, internet, and the rest is history. And so the last century has been about physics and tech, and that's created trillions and trillions of dollars of real wealth and massively improved the human condition. And our contention is, and my belief is, having sort of worked in this sector for 8 years or more, that the next century is going to be about biology and biotech. And the reason for that is actually kind of quite a simple reason, which is just that most of you create economic value from solving kind of intractable human problems. And most of the problems we still confront as a species are about biology and biological systems. So just to unpack that a bit more. So obviously that's curing cancer, right? That's anything therapeutic or autism or diabetes or any of these examples I gave a minute ago. But it's actually about much more than that. It's about, so for example, revolutionizing agricultural production so that we're way, way more efficient in how we go about, producing, both arable crops and indeed livestock farming. If we can do cell cultured meat, we could rewild 90% of the world's farmland that's currently used for livestock farming and for brutally murdering billions of animals every year. And that seems like, people talk about Franken meat, and it seems like kind of an unlikely scenario. But actually, as with so many things that move on technologically, human beings rapidly adjust to a new paradigm. And so I think that's a very exciting area. And things like limits on processing power. So because we're now coming to the physical limits of what you can put on a transistor, and that idea that processing power doubles every 18 to 24 months, Moore's law, per dollar spent, we're bumping up against the physical limits of being able to carry on doing that. And then there are a couple of step changes in how processing power works, are quantum computing and potentially biological computing, so DNA-based computers. And then the final one, again, still in life sciences, is clean power generation. So for example, biofilms on photovoltaic cells could potentially be much more productive than the existing solar power technology. So across the piece, we just think biology's got an amazing and very, very exciting role to play in technology. And it's also, it is about convergence too, right? It's about tech plus biotech. Yeah. It's an area I've been looking at you can see on the floor over there, actually, that's a lot of the source material for my next book. So we've just been doing a lot of work on all of these very exciting areas of kind of human ingenuity and innovation, really.
It sounds very exciting. Thanks you for enlightening me, because obviously the umbrella is quite broad of what this covers. And I mean, correct if I'm wrong, but in the past few years there has been a tremendous progress in that area, which obviously helps people, and then this attracts money in the sector as well, and then people are willing to actually fund new research and new companies that are trying to to develop new either cures for diseases, or try to improve agri-tech, try to develop basically new products, or progress the existing research that has been done already.
Yeah.
So
Sorry, go
the
on.
state of the art. Talk to me about a little bit about the kind of state of the art in life sciences, because and the progress that has been made. Because I remember you saying that when the past 10-20 years was all about big tech, from now on it will actually be more about biotech and life sciences in general.
Yeah, so that's the other. So if you like, the argument for why it's all going to be about biology and biotech is because that's where all the remaining problems lie. It's actually also because, in many ways, you could argue that biotech is more exponential than tech, and so the tech has progressed exponentially. And I said Moore's law earlier. So Moore's law, I would argue, is one of the most fundamental underlying drivers of human progress. And the fact that we have, life expectancy today is 4 decades longer than what it was 150 years ago. We have aeroplanes, we have smartphones. I mean, it's, human progress is the big underpinning of that has been Moore's law, which just goes all the way back to the steam age. And one of the very few areas of kind of scientific progress that is actually even more exponential than Moore's law, and therefore potentially even more exciting for kind of changing the world and value creation, is biotech. And a good example of that, which we use quite often, is the cost of sequencing the human genome. So being able to kind of read the code of life, if you like. Mm-hmm. When we first, so the Human Genome Project was basically a collaboration, between scientists all over the world, but kind of in the vanguard of that with the Brits and the Americans back in the 90s. And it took 13 years and cost $3 billion, an estimated $3 billion in sort of today's prices, to do that and to sequence the first genome. And it was a big piece of news. And from memory, I think it was Tony Blair and George Bush Jr., who must have been, the Prime Minister and the President at the time. I might have got that wrong, but I think that feels about right. You're making a lot of noise about that at the time. But fast forward to today, and to your question, what's remarkable is that it was 13 years and $3 billion to do it then, and today it's a few hours and costs less than $200. And that is one of the most fundamental underlying drivers of this potential value and this potential scientific development, but above everything else. But actually, across the piece, whenever you look at this sort of the pace of change and the pace of innovation here, there are lots of other areas that kind of look the same, and they all build on top of each other. So, diagnostic technologies, there's a thing called a next generation sequencer, or a PCR diagnostic, which was used a lot in the COVID pandemic. All of these technologies build on each other. And one of the so in 2020, the Nobel Prize for Chemistry, not for medicine but for chemistry, was awarded to 2 ladies called Jennifer Doudna and Emmanuelle Charpentier for a technology called CRISPR, which is capital CRISPR.
It's a protein, yeah.
I always embarrassed. It's clustered, interspersed, palindromic, repeats something, and I always forget what it is, which I probably shouldn't. But that is a gene editing technique which rests obviously on all those something like 50 Nobel Prizes going back over the last 50 or 60 years. That cumulative development and the ability for us to sequence a genome to use these diagnostic technologies. And indeed, so Jennifer Doudna in her book talks about the fact, so something as prosaic and seemingly commonplace as the fact that her team were using Skype. So when they were first developing the technology, they had scientists on 9 different time zones. So like in Vienna and Sweden and California, who were all able to do Skype calls and obviously latterly use WhatsApp and whatever else. And now, with a smartphone as powerful as an iPhone 13 or 14 or whatever we're at, or a Samsung phone, in the interest of balance, but you can share a file. Scientists can share across multiple time zones massive files that in the 60s would have taken a supercomputer in Cape Canaveral in like a huge industrial space, which now they can just share in real time across a free app like WhatsApp or Skype. And actually,
crazy.
Yeah, but for scientific collaboration and making human progress, that's been really important. And it's kind of, I think it's too seldom really understood or talked about or thought about. And so all of that put together means that, at the coalface now, so their technology, CRISPR, which, as I say, it's been around for about 10 years. It won the Nobel Prize just over 2 years ago. it's probably 2 or 3 years away from really the first tangible kind of, the cures for certain diseases. But CRISPR is one of the, there are many of these, but one of these technologies where basically scientists can now go into, if you like, with the genetic makeup of whether it's plants or human beings or animals, and make changes to the DNA. Now that sounds, and it is, very ethically challenging, playing God, and it's quite scary. But actually, I think the early signs are pretty encouraging for how responsible, the scientists and the government agencies and politicians and even religious leaders, the religious leaders have been invited into the discussions that these leading scientists are having, because it does ask questions about the role that we should play as a species. But ultimately, to be able to potentially cure any genetically inherited disease with a simple, with an edit to, if somebody's inherited a defective gene which causes them to have a really, really horrendous disease, we are teetering on the brink of being able to just go in, cut out that bit of the malfunctioning DNA and repair. And that is, I guess the big point here is that science fact in this space looks increasingly like science fiction. And there's a great quote from the guy who wrote 2001: The Space Odyssey, whose name escapes me from it. So Sir Arthur C. Clarke, who says that any sufficiently advanced technology is indistinguishable from magic.
Yeah.
And in my experience, there's just tons of magic going on out there at the moment. I think it's because not much of it has actually yet fallen out into here's a cure for cancer, or here's a really easy cure for autism or whatever else. But I don't think we're far away from that. It's not really entered the public zeitgeist yet. If you're willing to read popular science books written by Nobel Prize winners, you probably have you might have heard of some of this stuff. But the stuff that's coming through in the next few years is immensely exciting. And actually, in a time where we're all thinking about pandemics and Ukraine and cost of living crisis and how awful the political system is on both sides of the Atlantic, and it's a really, really fundamentally uplifting kind of, way of looking at human progress. And I like spending time looking at it as a result.
I like that you're always looking on the bright side, even at the darkest moments. You recommend websites. I follow you on Twitter as well, and you recommend websites that focus on human progress, and this never stops. As human species, we always evolve and we try to move forward.
Yeah.
And even though if you read the news, everything is going to hell. At the same time, we're making progress, and people in poverty are fewer than a few decades ago.
Yeah, and
we live longer and so on.
And we that I write about this. I've written about this a fair bit, but it's a really strange kind of bug in the system or malfunction of modern society that we choose to come home every evening, put the television on, and have somebody in a dark suit tell us the 0.01% of absolutely awful things that happened in the world today, and don't spend any time, which gives you a completely misleading idea of reality, because that is not reality. That's just dwelling on the tiny, tiny minority of things that are death, war, famine, whatever. I mean, even...
What sells, though?
What's that?
It's what sells, right? What sells clicks and
that's it.
Advertisement and so on.
Journalists, editors say, if it bleeds, it leads. It's a expression going back 100+ years, and I think it's a real tragedy because most people, right under our noses, there's always inflation's a problem. Ukraine is obviously horrendous, but at the same time, if you take a step back and look at the progress we've made, certainly since the Second World War, I mean, it's absolutely remarkable. But just the fact that, whatever people's view of the recent World Cup football, right? The fact that we have massive stadiums in the Middle East that people can go and celebrate and watch football from all over the world. People can travel on aeroplanes. I mean, it sounds spurious, but we are factually in a much better position as a species today than at any other time in history. And my own personal belief, based on what I see, is that that's just getting better. But we need to celebrate it more and talk about it more and focus.
Yeah. So, you spoke about the amazing progress that we are now making. In the next few years, we'll see a lot more of these things in life sciences. And I remember, if I put my investor hat on, and obviously, people, my audience, obviously your audience as well, they invest, they try to, put their savings to work and beat inflation, basically. I remember reading the Financial Times article that covered the investment company that you are launching and on life sciences, and it said investment manager of the company, plain English finance, wants to acquire stakes in life science and medical technology businesses that it sees as undervalued in the UK, Europe, and Australia. It is targeting annualized total returns of 20%. So that's, amazing in my mind. Obviously, you'll talk to us about the disclaimers and all that, but please tell us what makes this possible. Why do you think this is this first of all true? And talk us a little bit about the new investment company that you are launching right now that focuses on life sciences.
Sure, yeah. So it's called the Conviction Life Sciences Company, and you're right. So anyone giving consideration to that has to take account of a raft of disclaimers. So yes, 20% is the aspiration, the target that we've put in our prospectus, and we've spent 18 months working on writing that prospectus and doing all the modeling that underpins it and all the thoughts of it. And I've obviously spent 8 years meeting dozens and dozens of companies. And the reason we believe it is a realistic aspiration and crucially, it's a long run annual return, and it's not this is a volatile and risky sector, and it's very important that everybody takes account of the risk factors in a sector like this. But it's a reaction to a structural opportunity which we perceive, which we think is very rare, which is that basically outside of the United States, notwithstanding everything we said earlier about the march of human progress and this incredible science, and the fact that we're teetering on the brink of curing cancer or any genetically inherited diseases, the fact that these businesses could revolutionize agriculture, they could revolutionize processing power, and notwithstanding all that huge potential value creation that can come through, for a bunch of structural reasons, life sciences companies outside of the United States in particular are, in our opinion, thoroughly undervalued. And to put so if you're thinking as an investor and using kind of really, if you like, kind of an old school thought process about that, is we believe that it's possible to constitute a portfolio where a significant number of companies, particularly in the UK and Australia, are currently capitalized where their 3 to 5 year profitability could be. So in the vernacular of a kind of professional investor, they're on a 3 to 5 year forward PE of 1, EV/EBIT of 1.
Okay.
Yeah, and that's basically because if you're a loss-making company, let's say you're loss-making today because you're spending millions of pounds on R&D and you're complicated and you're an R&D driven business that may or may not get through and deliver a drug for a given disease, and then you succeed in that trajectory over the next 3, 4, 5, 6 years, let's say, you might then be a company that does 500 million of revenues and 100 million of profit, right? Let's just say. So now you're a loss-making company that could be valued at, let's say you're currently valued at 200 million pounds on the AIM or the LSE or the ASX markets, on the stock market. And I just use the example of 500 million and 100 million of profit. But actually, what our belief is, there are a number of companies outside the United States that today are, say, valued at 200 million that have half a chance of making 200 million of profit, 4 or 5 years from now. Now, this sector has very significant clinical and commercial risk, of course, and nobody's denying that. But our basic thesis is, if you put together a portfolio and we want to put together a portfolio of about 40 companies, and to be clear, not all of them are, if you look, a potential on a P of 1. There's a lot more to it than that. But we believe there are quite a number of companies of which that can be said. And so if you even only hit kind of average success rates in terms of the success of the clinical trials, the fact they get through their clinical trial trajectory, their commercial success, they do deals, they're able to sell a drug that works. If you hit kind of average rates, if you had a portfolio of those companies, then if you only have an average number of them succeed, kind of based on history, that implies a very interesting return for the portfolio as a whole. And so if you like, that's the fundamental insight of what we're trying to do. And then I guess the next question is, okay, so why is the market so seriously undervaluing these businesses? Why is it possible to do that? And the answer there, I've lived and breathed for basically the whole of my career. It is far more to do with the structure of our investment industry than it is to do with the companies. And just to explain that, because this is, again, if I hadn't have kind of had this experience personally for many years, I wouldn't believe this and I wouldn't be doing this. But basically, these businesses are definitionally smaller companies. And as I said at the top of the call, I've been a smaller company specialist since the late 90s, right? And so basically, smaller companies, if it's in the FTSE small cap or even smaller, on listed on AIM in the UK, just talk about the UK for now.
Yeah.
It's definitionally a smaller company, and all of the money that is tasked by mandate with looking to invest in smaller companies, basically all of that money, untold billions of pounds, is run by generalist investors, right? And I know many of those individuals. Many of your audience will, if you've ever invested in a Fidelity or an Aviva or Legal & General or all these businesses that have smaller company funds. The people who run those £1 billion pots of money or 100, £200 million pots of money are all generalists. And they've had a real problem with life sciences and biotech because, firstly, they have a problem with any sector that is loss-making because you can't use conventional valuation techniques like PE ratios or return on capital employed, or if the company is
if there are no earnings.
Yeah, exactly. If there's no earnings, and so they have viewed these companies as very specialist and very risky and kind of very scary and outside of their area of expertise. And you can entirely understand that for two particular reasons. Firstly, a lot of the smaller company fund managers, I've written about this a lot, how smaller companies has been a great place to be, and the long run returns are like 15%, all the way back to 1955. Average annual returns in smaller companies are the bottom 2% of companies by size, and the UK stock market is north of 15%. And that's research by Dimson and March at the London Business School. And so it's very volatile, but if you're willing to invest for the very long run, it can be an amazing place to generate returns. Now, the people running that money have managed to achieve that investing in Games Workshop or Britvic or ASOS or EasyJet or whatever. They haven't needed or Superdry before. Some of these businesses have obviously gone the wrong way in recent years, but Games Workshop's a classic smaller company equity story, right? And it's created so much value in the last many years. And so these fund managers feel very comfortable with businesses like that, growing organically, doing something that you can understand, making profits, growing by acquisition, opening in new markets overseas. That's their core kind of role. That's what they do. And so that's the first reason that they can't use conventional valuation techniques on life sciences companies, and they haven't needed to because they've had great returns for many, many years. And the second reason, which is quite a prosaic reason, is that most of the people running the biggest pots of money here, until recently, when quite a few of the really key people retired, actually, including a guy called Harry Nimmo, who was originally at Standard Life and Aberdeen Standard Life. He retired only a few weeks ago, and is one of the highest profile small cap fund managers, following people like Mike Prentice, used to be at BlackRock. He retired, 2 years ago. But a lot of the guys and girls running those large pots of money were investing in the late 90s. And in the late 90s, there was the first flourish of biotech, if you like, Biotech 1.0, where biotech had all this promise and all this hype and all this hot air, and it blew up a lot of capital. And, let's remember, it's a very dangerous phrase in investment saying it's different this time. I fully acknowledge. But it is different this time because of all that stuff we said about the technology. In 1990s, it cost $3 billion to sequence a human genome. In the 1990s, there was no such thing as an iPhone. It's a completely different basis in terms of how the technology stands and how it's developing. But many of those fund managers running the biggest pots of smaller company money, which could support these companies, just decided, once bitten, twice shy, I don't need to engage with this sector. It's risky. These businesses lose money. I don't really understand it. And also, for them to commit to a sector like this, they really need to own 20 or 30 companies. Because these businesses are risky, because they're early stage, because they're loss-making, because some of them fail clinical trials, you need to have a portfolio approach. So imagine if you only really want to have 50 to 100 shares in your portfolio to be able to do your job effectively. It's a very big decision to decide to add another 20 or 30 just from one little subsector called life sciences, right? Particularly when 20 years ago, life sciences was very small as a percentage. So it's kind of not worth your time. It's not worth your focus. It's risky. It's scary. And your experience of it is that it's destroyed a lot of value. So it's very, very, and meanwhile, you're able to generate 14% annualized returns doing your day job, investing in Games Workshop or whatever else. So, many of these people were my clients, in my career. So I fully understand their rationale and why they've behaved like that, and why, and everybody works in their own logic bubbles, and that was the smart thing for them to do. But as that's gone along, these companies have developed massively in terms of the science and what they're actually potentially able to do. but they're still unloved by that audience. So then the next thing to say is, okay, so if the generalist investors, which have all the money that could potentially support these companies, are not interested, which is extremely challenging and frustrating if you're running, a company that's spun out of Oxford that has a great manufacturing technology that could strip billions at the NHS. I mean, these people have worked so hard running on fumes, not supported by the domestic market, because the other challenge for them is, and I know about this firsthand as well, because I've confronted this myself in my career, is, okay, well, why not go and speak to the big specialist biotech funds that do understand what you're doing and could make an investment? And here you have another intractable problem historically.
They're too big.
Exactly. Most of them are in the United States. The huge majority of that capital that has PhDs and doctors and all the specialist people required to interrogate a complicated biotech manufacturing company or company trying to cure cancer. Most of the capital that would do that sits in the United States. And if you're a big $4 billion fund in the States and I call you from London saying, have I got a company for you? Look at all your mid-cap companies in America that are worth $2 billion. This British company is worth £300 million. And, I think based on any kind of fundamental analysis, that there's no reason for that valuation discrepancy. And the valuation discrepancy can be of that order of magnitude, or certainly 3, 4, 5x, depends on exactly what you're talking about. It's horses for courses. But the key to our thesis is, so those guys have got too much capital. They have to write $100 million checks, sometimes even bigger checks, because they can't have like 500 different shares in their portfolio, right? So if they've got billions of dollars, they just can't look at small companies. They also don't want to take the time zone risk. They don't want to take the currency risk. They've got 300 companies listed on NASDAQ on their doorstep that they can fish in those waters. And they've got to look at all the big cap companies. So basically, you have this incredibly intractable structural problem for many years that the domestic small company generalist investors are not interested, and the mega specialist healthcare investors in the States or in Singapore or Zurich or wherever else can't, because it's just too, they have to draw a line somewhere and they just say no to anything kind of sub $1 billion perhaps, and overseas. So, okay, so that is why these companies have all become structurally, if you compare them. And I think, we're certainly not the only people who see this. This is something that gets talked about for years. George Freeman is the life sciences minister in the government at the moment, did a speech last Tuesday about making Britain a life sciences superpower. And, all of the thought process around them trying to do that and the government trying to support this sector more, a great deal of that derives from everyone identifying all the challenges. Why can't we grow multi-billion-pound companies either in tech or biotech? Well, it's all to do with these problems, right? And like something like 12 of the last 15 British life sciences companies that have floated on the stock market have floated on the NASDAQ stock market, not in the UK, which is a tragedy for Britain. And actually, none of them work on NASDAQ because the American investors have got so many of their own businesses very, very few of them work on NASDAQ. So that in itself is, in my opinion, strategically not the right thing to do. What we need to do is support the British stock market and British science and keep this stuff on shore. And so then the final bit, if you like, and sorry, I'm conscious that I've been monologuing at you. Do stop me if you want to.
No worries. I do have questions coming in while you talk, but please continue.
Well, all I was going to say is, so then the next question, okay, fine. So they're structurally undervalued, and they have been for 20 years, and it's always been the poor relation of America. What's going to change that? Like what? So what? If it's always been the case, that's just what somebody might describe as a value trap. Okay, so they're undervalued and I buy a load, and then they remain undervalued for another few years, and it's a crap investment, right? Sorry, probably a slight. And my answer to that, again, just from personal experience and from personal belief, is there are basically two reasons why we're on the cusp of a change. And the first reason is because we're not the only people seeing this. Basically, some of the biggest, smartest, richest investors in the world are beginning to wake up to this valuation discrepancy. And there are a couple of reference transactions that are examples of overseas specialists finally going, wow, that company is only valued at £200 million and is really good. And I won't mention it by name sort of for compliance reasons, but there's a British company that now has 90% of its shareholders are big specialist foreign investors. And that's really the first time that's happened. And just from personal experience, there's no, as a statement of fact, there are many of these big VC funds, specialist VC funds, that have billions and billions of dollars they've already raised, whether they're sitting in Singapore or Boston or San Francisco or Paris or wherever. And they are increasingly looking, in my experience, at these businesses because of that valuation differential. And if you like, the cure for low prices is low prices eventually.
Yeah, yeah.
And so I believe there's an element of that. And that's a kind of personal experience, funds flow, valuation, kind of anecdotal argument. But actually, if people could look at me and go, well, you could be wrong. You could have said that at any point in the last few years. That's your own personal opinion. You might be wrong. I think the much stronger, more empirical argument, and in some ways the simpler argument, is that point I made earlier, where it's what we just describe as commercial delivery. So in the 8 years I've looked at these companies, a lot of them have gone from an idea that needs millions and millions of pounds and many years to kind of navigate from being preclinical or phase 1 through to actually potentially being able to do a deal with AstraZeneca or Pfizer or get clearance for a medical device or whatever. And so they've done several years of running on fumes to get to where they are today. And where they are today, in my opinion, is actually maybe not more than a few years left to actually delivering, significant revenues and significant profitability. But the market, because of all the reasons I've set out, isn't giving them credit for that. And so, if we're right, there are going to be 7, 8, 9 more FTSE 250 mid-cap businesses. There are going to be a bunch of businesses that are 200 or 300 or 400 million pounds today. There will be 1 or 2 billion pound companies, and dare we hope 1 or 2 of them might even be 5 or 6 billion pound companies, and in the FTSE 100 in the next few years. And so the final point about that is, if we're right, that will give the banking industry and the investment industry enough critical mass to be much more interested in it. Because if there are 6 or 7 new 2 billion pound companies in London to have come out of this crop of companies that I think are teetering on the brink of delivering that, then all the investment banks it will be commercially interesting for them to write research on those companies, because there are secondary commissions and there are banking fees to be earned in a way that it just hasn't been in the past. I mean, if you're a 200 million pound London listed business and you want Goldman Sachs or JP Morgan to work for you, forget about it. It's just like, it's never happening, right? And so then they've been really challenged in terms of even getting help from investment banks, because all the small investment banks tend to be generalists as well, and be more comfortable doing stuff that isn't high science. So there are all these reasons. It's like it's been this rubber band is so stretched because of all these reasons, and we just think it's going to snap back in the next few years.
It really surprises me when I hear about these structural differences between the US and the UK, and in generally, companies that are smaller, how this, you might call it myth, you might call it the reality, the efficient market hypothesis plays out, where people say that basically it's one of the first things that you learn in finance, that when you start investing, the share price and the company is valued efficiently by the market. Yeah. So all the information that is public is actually priced into the share price, whereas you basically say the entirely opposite, right? You're saying that because of all these structural reasons, now these companies are so different to what they should be in terms of pricing, and obviously if you can get the trend going, and the trend is your friend, they say, right? If you can get the trend going for you, then obviously this will help kind of bridge the gap between the smaller UK businesses, and not just UK, I guess, but non-US, let's say, businesses versus the US.
Yeah, but just on the efficient market hypothesis. I mean,
yeah,
I think I'm right in saying there have been 5 Nobel Prizes for economics awarded to economists working in behavioral economics, and the idea of asymmetric information. And it just astonishes me by now that we haven't taken account of that. It's like, markets aren't efficient because American investors are parochial and local, and they have these considerations of they don't have enough human resource to look across the Atlantic. If the capital pool available to look at American smaller company life sciences is 20x the capital pool available to look at UK life sciences companies, how can the UK be efficiently priced against an American company based purely on fundamentals? It's not about fundamentals. It's about the underlying dynamics of the funds flow of those businesses. similarly, at the other end of the spectrum, I think markets theoretically get more efficient if businesses are very big and very liquid.
Mhm.
I think there's
Yeah.
an element of market efficiency there. But then look at Tesla. How can Tesla now be 70% down or whatever it is now on where
Same
the
for
official
Facebook, right?
market thought it was a year ago, right? I mean, it's like
Yeah.
so I genuinely, sometimes I get butt heads with people on Twitter or whatever who are massive converts to the efficient market hypothesis and will cite all sorts of academic research at you and clever mathematical models that say, no, it does exist. But, if you've ever worked for smaller companies, you can only think that the efficient market hypothesis exists in the ivory towers of academics and people who've actually never been at the coalface of particularly smaller companies and particularly life sciences smaller companies, because these arguments, these are actually really kind of easy to evidence empirically, right? Everything I'm saying, it's not like, oh no, that's not, the fact that there is a discrepancy, the fact that British companies have been challenged in terms of raising cash, anybody working in that industry knows it's true. Whether or not it unwinds in the way that I think it might is more.
Yeah, it's a different story. Yeah. Well, it's a good, it's a good point, I think, about efficient market hypothesis. And I know I'm always trying to learn more about this stuff because obviously as an investor, I'm trying, to make the most out of it, right? And at the same time, I understand that this can be quite challenging, right? So why not just, leave it and invest in a certain lazy way and get on with life. But speaking of your friend, just to wrap up the discussion about investing in life sciences.
Yeah.
What would you say that what allocation range would be prudent for a typical investor in that has a long term horizon? Let's say what would you suggest they do?
So that's a very, very challenging question, right? Because, the whole thing about veering towards investment advice. I mean, if I sit here and say you should put X% into this, that's a very sort of unethical thing to do. And because,
you don't have to answer that. Just for me, it's like,
I'll give you some thoughts on it, which hopefully are vaguely useful. Because the thing is, if you're a 40-year-old and you've just sold your business for £10 million, and you're a 40-year-old who earns £30,000 a year, the appropriate amount that you might put into a biotech fund is obviously incredibly different, and that's why it's super important to take account of people's personal circumstances in any kind of assessment of what the appropriate allocation to riskier stuff is. But what I would say is, I think you and I have had this discussion before. If there's one elegant, one-size-fits-all way of thinking about your allocation to aggressive stuff and defensive stuff, which I've written about in my second book, it's this idea of 100 minus your age, which is, so basically, if you subtract your age from 100, it gives you the percentage that you might put in aggressive stuff. So if you're 30, 100 minus 30 could potentially be 70% aggressive and 30% defensive. And then I argue that every 5 years, you only need to think about this every 5 years. You don't need to think about it every month or every year. But every 5 years, big picture, or even frankly every 10 years, when you're 40, you could be 60% aggressive, 40% defensive as you build a pot up to retirement. And the reason for that is because, and apologies to any of your audience who've heard me say this because I've said it so many times, but if you're 30 and you're in the market, let's just say you're 100% aggressive and you're in the market. And by the market, we mean equities, right? And there's a big 50% pullback in equities, as happened in 99, 2000 or 07, 08, or nearly last year. If you're in the NASDAQ, that was down 30% or more, right? And so now let's say you've got 10 grand because you're 30 and you've saved about 10 grand by the time you're 30. Well done. That's a pretty good result for a lot of 30-year-olds, especially nowadays. You've had it in the market, whether that, or you had it in Bitcoin, right? But you had it in something that was aggressive, and now it's down 50%. Now you've got 5 grand. Your percentage, that's annoying. But now consider somebody who's 60, and if somebody who's 60 has £1 million because they've spent a lifetime as a lawyer, or they've had a decent career and they've done well, and they've listened to people like you and me and invested in the market, and now they're 60 and they're 100% in the market because they haven't thought about this process. And they've got £1 million and the market falls 50%. They've gone from 1 million to 500,000. And obviously those are two incredibly different problems, even though it's the same percentage change and the same diminution.
Huge difference, yeah.
It's a totally different. And so my point is, if you're thinking about the approach, I think that so a 50-year-old should basically be 50% defensive, 50% aggressive in terms of where they are with their assets today that they've already saved and what they're investing every month if they're able to invest every month. They should maybe put half into something defensive and half into something aggressive. So I guess my rule of thumb would be then, what is aggressive? Well, aggressive, the simplest thing to do to your efficient market hypothesis argument, if you want to put your investments on autopilot, is just a big equity index, whether that's the S&P 500 or the MSCI World or the FTSE, or if you live in France, the CAC, or whatever. Just a big equity index, just buy it every month for years and years and years. And that's the easiest aggressive thing to have. The other two aggressive assets that I'm a big believer in are smaller companies, as I said earlier, particularly if you're in the UK and it's quite easy to buy a good quality smaller company fund, and life sciences or biotech. And so I guess what I'm saying is that, let's say you're 50 and you might put 50% into aggressive stuff. You might put the biggest chunk of that into just a big equity index. And then you might put a smaller percentage into something racier that can potentially deliver higher returns, but has higher risk, into something like biotech or smaller companies or tech or whatever. So I hope that's vaguely helpful in terms of not answering the question because I can't, but still sort of vaguely answering the question.
No, of course, it's and thanks for providing the overall approach, the high level overview, let's say, for different people, because obviously what you said is spot on. Different investors can have different allocation based on their age and their wealth as well. As you see some high net worth individuals that are they want They obviously will hurt if they lose money, but they can definitely have the luxury of investing in more aggressive bets, right?
And it's all about your personality as well, because there are people who they've put £1,000 in an ISA in the market and they're down £50 who will have sleepless nights. Then there are multimillionaires who found it relatively easy to build a ClickFunnels funnel and sell a product online, and they started from 12 months ago and they've just made $16 million selling something online or some YouTube, for whom easy come, easy go, because they just believe they can easily make money. And it's very, very important for individuals and anybody who advises them to take very diligent account of what your own personality is, because you don't want to be lying awake at night worrying about what your own, what your investments are doing. You want to make sure you calibrate. But equally, by the way, as an aside, there is such a thing as underperformance risk. In a highly inflationary world, if you're not beating inflation, you're not making any forward progress with your finances. And I think that's very poorly understood by British journalists, by the way, who are constantly going on about cash ISAs and which to me is just terrible investment advice to ever talk about something that's going to materially underperform inflation. But that's what most of the country only ever invests in: property and cash ISAs, which is a very, very poor way of allocating your investments over time, in my considered opinion. So,
and I know your controversial views about property, not so much about property, the asset itself, but more about the allocation that British investors have in their portfolios, because it's huge, right?
Just so you don't doing the maths, right? I think the biggest problem in the UK is people don't think sufficiently about property with regard to rental yields over time, what property really does over time, and most particularly the difference between nominal and real development in the price of property. Because if the pound, I was just reading a new finance book that's coming out from a guy called Rob Dix the other day, making the point that the pound is down 99%. The value of the pound's down 99% in how many years it is, like a century or whatever it is. But it's that, and so if people aren't taking account of the fact that, why was a house £50,000 in 1980 and it's £500,000 today? Well, it's actually not because the house has gone up 10x in real terms. It's because the house has gone up 10x in nominal terms because the pound's gone down so much. Nobody earns much. And I think so. You're measuring property with an elastic ruler if you're just using pounds and saying, "Oh, my house is up." Particularly if you add into the mix the fact that a pound used to be worth $2 and today it's worth $1.2. So, and 80% of the world's stuff is traded in dollars. So, in terms of oil and cotton and wheat, and you're down. If your £1 million house was worth $2 million, well, today it's worth $1.2 million, and you've lost a lot of money in real terms. And nobody, like estate agents, don't think like that. 90% of the population don't think like that. And all I'm saying is, I'm not a bear of property. I just think you need to think about it more deeply to really interrogate whether you're making forward progress with property or not. And and what if interest rates a 6% again instead of 2%. I mean, most people strike their mortgage without even thinking about the chance that interest rates could be 6 or 8%, and that's going to cause real misery. I think.
Yeah, when the music changes, of course. Yeah, it's a good point. Cool. I mean, thanks, Andy. Any final words that you'd like to say? Like, where can people find you online, or find the fund that what you're launching, basically?
Yeah. So, well, obviously, our website's plainenglishfinance.com or plainenglishfinance.co.uk. The new company that we're looking to float on the stock market. Although I think this podcast might be published after we've potentially done that. So, in which case it will then be on the stock market. I mean, it will certainly be, our website will still be up in lights and people can find out exactly where it's at and what's going on. And that website is clsc.uk, not .co.uk, just .uk. So and that stands for Conviction Life Sciences Company. And the really important thing, just to stress, if there was a last thing to say, is, because I'm obliged to say this for good order, is it's really, really important to understand it's notionally a high risk product, high risk, hopefully high reward, to your point earlier. And all of, part of the reason it's taken 18 months and, how much ridiculous amounts of money I've spent on risk from our company to do this is because we have to prepare really detailed, the prospectus, the primary legal document and the key investor document and all these documents which set out the risk factors that people must take account of before they consider an investment. And it's very important to stress that for kind of regulatory and legal reasons.
Cool. I mean, thank you very much, Andy. I appreciate you coming here and talking to us. So thank you very much.
Lovely to see you as always, Michael. Thanks for all the work you do. And let's do it again in a year's time when we've got something else to go on about.
Yeah. Looking forward to your progress. Great. Yeah. Amazing. Thank you very much.